Yeah, starting now. Hey everyone, this is Andrew Vargas. I'm a realtor based in Southern California, and today I have Brett on. He's an investment advisor, just to provide some clarity on how to invest and planning, especially now in these times. Brett, if you'd like to introduce yourself, please do so.
Yeah, hey everyone. I'm Brett Sifling, SoCal native, investment advisor and head of the Get Invested program at Gerber Kawasaki. We're $1 billion RIA firm or wealth management firm here in Santa Monica. So we manage money for about 7,000 clients all over the US and across the world, actually. So we help a lot with financial planning and basically the investment management behind everything.
And Brett, how long have you been doing this?
Yeah, so I've been in the finance world for about a decade now, actually. So I have a pretty unique history when it comes to all this stuff. I actually started trading and investing very early on in high school. And so I began posting everything that I was learning online. These trading apps like Robinhood and things like that didn't really exist yet. So not a lot of young people were actually interested in finance, even just a decade ago. It's been a huge upswing. So I was posting everything that I was doing online and ended up getting a lot of media attention from it. And so I ended up opening up a website, which was a subscription-based blog where I was putting out a lot of research on my trade ideas. And through that was Business Insider's 20 Under 20 of Finance, featured in the Wall Street Journal, and really propelled and launched my career from there.
Nice. And I did notice that one of the ways I actually found you was I think I saw a segment of yours on Reuters, right? I think you kind of go on there quite often, sometimes CNBC as well.
Yeah, so we've been doing a lot of media coverage for the firm. Me and Ross, our CEO, as well as some of the other managing partners. Well, we're really the newsmakers in our industry. So, when like Tesla earnings come out this afternoon, for example, Ross Gerber, who's our CEO, is going to be on CNBC chatting about that. I was on Reuters this past week talking about stocks that are ideally invested in while we're all staying at home. So companies like in the video game sector, and just some quick disclosures here. We might talk about individual companies or investments, and please do not take anything that I'm saying and specify it to your situation. This is all general advice, and if you actually want to develop a financial plan or get advice for your specific situation, please do reach out to us. Don't take anything that we're saying here and enact it on your own, for sure.
Thank you for disclosing that. I think people will definitely probably reach out to you and ask you some questions beyond this video, I imagine. So feel free to contact him. I'll leave his information as well. This will be linked up onto the YouTube platform, so I'll put your email there and things like that, phone number. Now today I kind of wanted to focus on the millennial demographic. And I kind of wanted to put it into two different segments. One segment being maybe the younger millennial, maybe someone that's still single or just recently engaged, versus someone that's a little bit older in the millennial demographic, but they may have children already or married, and they're a little bit different in terms of the risk averse of their portfolio. And I kind of wanted to get an idea of what you would recommend and things like that for those two different groups.
Yeah, it's very interesting, and each group, we classified these people as groups, but honestly, if you get even more granular, each person's financial plan and each person or family's investments need to be customized and specific to them. So when we're talking about these general concepts, it's much more advantageous to get someone that's dialed in on your exact plan. Working with a firm like ours, we're completely independent, for example. And so we don't actually have any proprietary products of our own. And so what that means is we get to put together these plans based on research that we've done on tens of thousands of different investment options, really everything that is out there, stocks, bonds, mutual funds, ETFs, other products. And ultimately what happens is it gives us an ethical advantage over the companies that are proprietary, like the big banks, for example, because we don't have an incentive to put people's money in one thing versus another. It's truly just about what's best for that person. And we're also fiduciaries in that capacity. So we actually have a legal obligation to do what's in the best interest of these people. And we do work with a lot of the younger generation because our firm specifically doesn't have account minimums. So, when we're looking
Okay.
at maybe the younger group, right, the core that's just getting started, maybe you recently graduated college, maybe you're a year on the job or a couple years into your job, right? And you're wondering, okay, now I'm maybe making a little bit of money, and I want to invest it, right? Or I want to buy a home one day, or I want to retire one day, right? And they have all these goals that they want to achieve, but where do you start? Right. And so what we do with this group, you could say, that's just getting started, is we have a wealth building program. And what this program is all about is basically establishing your core accounts, okay, and creating a plan based on your goals that you do have, maybe buying a home, right? So that you have somewhere to put that extra money at the end of the month, and a systematic way to build wealth over time. Okay. So really, with this wealth building and this first group, the key point is really just to get started. Right.
Mhm.
And a lot of these people, maybe they don't even have a non-retirement account, or maybe the only investment account that they've had is the 401k. So we're really sitting down with them and mapping out, hey, if you want to buy a house in the next 5 or 10 years, here in California, sometimes that's what it takes
Take-
with
Yeah.
the extreme home prices. And we basically put together a plan on how much they need to save and invest and how aggressive they need to be to get there.
Now, do you kind of put it into segments in terms of like, I know you were mentioning it all depends on the individual and what their specific goals are, but do you mention like, all right, put this percentage into individual stocks, these ones in ETFs, and then these ones in treasury and corporate bonds? I'm just kind of curious as how the process is set up, because it sounds like for someone that may be just getting started, you help them from the bottom up. So I just kind of wanted some details on that.
Yeah. So again, this all is dependent on you as a person, right? What's aggressive to me or conservative to me or you even, it can be very,
Mm-hmm.
very different from what another individual thinks is conservative investment. So we use these like buzzwords, right, in the industry and in both of our worlds, but
Yeah.
not a lot of it has actual context to it. So, generally, if you're actually saving for a home and you're almost there, let's say within the year, you generally don't want to actually be in the stock market at all, whether that's individual stocks or mutual
Mm-hmm.
funds or ETFs. If your time frame is 6, 8 months down the road and you're ready to buy that home, you don't want to be in the stock market because inherently there's a lot of risk in the stock market. There's a lot of better investments that are out there for someone that's in that situation. Maybe looking at something that's more conservative than stocks, like municipal bonds, for example, which are state and local government bonds that give you tax-free money towards your goal. So, or a plain old savings account. The problem
Mm-hmm.
with savings accounts versus maybe taking on a little bit more risk with the municipal bond side is that people don't realize a lot of the times that savings accounts are actually taxed. So if you're lucky if you get a tenth of a percent in a regular bank, right, in a savings
Yeah.
account. And if you get a high yield savings account, up until the last couple months, they were paying you maybe 1.5%. They're even lower now, but that full amount's taxable when you can go out into the municipal market and a lot of times get,
Mm-hmm.
3, 4%, and that money's actually tax free towards you. So especially if you're in a higher tax bracket individual, it's very advantageous for you.
Wow, that is very interesting. I didn't really know about them taxing you so much in terms of the savings account. So it does make sense, like you were saying, if you want to add on a little bit more risk, you put it into muni bonds and things like that. So, like, let's just say hypothetically, there's someone that's going to buy in a month. They're going to start looking to buy, right? And they already have, let's say, would you say like if they had 80% cash ready for their down payment and put 20% in, I don't know, the stock market, do you think in your perspective, is that something that's maybe good to do, or is that a little too risky, you think?
Yeah, again, if you're especially if you're gonna buy that home in a month, I wouldn't have a single dollar that you're planning to put in there into the
Wow.
stock market at all.
Yeah.
Because over the short term, markets are largely random, right? In any one year, you have about a 75% chance of being Right. And actually, this scenario happened a lot with the robo advisors this year, with the Betterments of the world, right? So a lot of times, you go into Betterment, you think you're getting a good deal. It's only 25 basis points a lot of the times, right, to manage your investments. Well, it's actually, you plug in, you're saying you're okay, maybe I'm risky, but you're not actually talking to a human, right? And what I've seen is a lot of these portfolios were invested in stocks, and not only invested in stocks, but
Mm,
they're highly allocated to stocks, even if the goal was a year or two down the line. And as we all know, we're going through a global pandemic right now, and while no one could have predicted that, stocks went down over, about 30% from peak to trough, what we just went through. And could you imagine if you had $100,000, right, saved up for your home down payment, or $200,000, and now
yeah.
that's 70, or that 200 is now 150? Okay, it's like a significant amount of money. And what happened was people kind of just plugged into these robo advisors, didn't think about it, didn't understand what they were actually invested in, and now a lot of these people are rightfully so angry at these places for having such a big allocation and such an aggressive allocation when they really didn't need to be.
Mm. So I think that's kind of why it's so crucial, especially when you're using your own money and investing in yourself and building your own wealth, to use an individual, an actual person you can talk to and communicate your goals on a, I don't know whether it's day to day, month to month, or week to week basis, versus having a robo advisor help you with that. That's very interesting, because I feel like now a lot of these big groups are pushing a lot of us younger, millennials, to go into the
Absolutely.
robo advisor uh,
Yeah, and
aspect.
it's funny too, because people, some of the pushback, if we get as investment advisor or financial planners, it's like, oh well, maybe your fee is a lot higher than a
Mm,
robo advisor. And it's funny because I almost think the opposite. I think you guys are paying way too much to have a robo advisor. You can pay 25 or 50 basis points, to send your money to Betterment or a robo advisor. Well, why wouldn't you just pay 10 basis points at Vanguard and just do it there? It's the same thing, right?
hmm
So it's just a better platform and a better user experience is all that you're really getting.
Yeah. Wow, this is
But
really good that we're doing this, because I I don't know why, but I didn't really think about, like, someone's looking to purchase, right? That I thought maybe it'd be okay to leave it in the stock market, but based on what you're saying, it might be best to have most of it in cash, so you can just have it right then and there, versus something happened like this pandemic and all of a sudden you get wiped out uh, based on whatever fell in the stock market.
yeah, the stock market's volatile, and like we mentioned, there's the bond market, which is a completely different animal, which a
Mm,
lot of times you can take advantage of, or just other products that are out there. But yeah, that's probably the number one mistake I see with a lot of these younger
mm,
investors and younger individuals, that they want to get into that first house so bad, right? And they just want to
yeah,
do it, and so they go as aggressive as possible. They go, as much money as possible, and then they end up, also remember, a lot of what I've seen, at least, is they take every last dollar that they have and put it into that home down payment. And generally we don't recommend that either,
mhm,
because a lot of the times you're forgetting about other goals in life. And I know we're talking about real estate specifically here, but you don't want to be fully invested one way or the other into any specific goal, right? Because if you're putting all your money down towards your home down payment, you might be forgetting about, let's say, like retirement, right? And in that second group of individuals, maybe that they're 30, they're a little bit older, of a millennial. They maybe have a family, right? They have kids. We mentioned that kind of second one.
yeah,
If they haven't started saving for retirement yet, and let's say they want to live a modest, $150,000 lifestyle between, their household, they actually have to save around, I think I did the math, and it's around $3,300 a month, every single month for the rest of their lives. Versus if they were paying attention to that goal, maybe while they were also saving for their house when they started at age 21, they only need to save around 1,300. So it's
that's the
almost a
difference between
third.
compound interest, right?
Yeah.
Starting early
So
versus starting later.
exactly, compounding interest, as they like to call it, the eighth wonder of the world. Just earning interest on top of their interest on top of your
Yeah.
interest. It truly will change your life if you can understand this concept and the time value of money.
Got it. Got it. Okay. Yeah, that's so crucial because I feel like a lot of I don't know the statistics. Maybe you do, but I feel like the majority of really young people don't really invest in a retirement account, let alone an individual brokerage account.
Yeah, it's a lot of people don't even have an emergency fund, right? That we're seeing this right now.
Hmm.
With this all this government assistance and everything, that a lot of people don't even have more than a month's expenses, let alone investments. So, it shows you the importance of even if you can put away $50, $100 a month. Sometimes I, get the question, well, it's like, is it even worth it to do that? It totally is because
Yeah.
there's not just the dollars and cents logic to these conversations. A lot of the times it's emotional, right? And we're emotional beings. And if we can see progress and see that behavioral change in ourselves, a lot of the times we get excited by it, right? And we're able to hit that goal a lot easier.
Okay. Now, what about in terms of like I've heard, again, I'm not an expert at this, that's why I have you on, but I've heard the ETFs tend to be a little bit more risky than, let's say, if you just go with the individual stock. I'm asking because I have a lot of clients sometimes that they just say, oh, I just throw it in an ETF. I don't even buy individual stocks. And in my opinion, I would probably, I feel like it's probably better in a way to put it in individual stocks, but I don't know. I kind of want to get your
Yeah,
idea.
good question. So it's actually flip-flopped. ETFs, so let's kind of like take a step back, right? ETFs and mutual funds, all those are, it's a pooled amount of capital with a common objective. So it's a bunch of people getting around a table saying, hey, we want to grow this money, or we want to produce income with this money, or we want to invest in a specific sector of the economy, like real estate or cannabis or healthcare, whatever it is, right? And so these are diversified baskets of stocks. So in these diversified baskets, they'll hold anywhere from 50 to, let's say, 250 different companies inside that diversified basket, sometimes even thousands, right? And so if you
Hmm.
just kind of like take a look at it from a step back, owning, let's say, $1,000 worth of 100 different companies is just inherently less risky than owning $1,000 in one company, right? Because that one company, who knows what can happen? Maybe their product fails, maybe their CEO dies in a plane crash. Like, you never know what can happen in any one individual company. And so that's why we actually prefer, especially as
Got
young
it.
investors, when you're getting started, to invest in mutual funds and ETFs. And the second reason too is it's, it gives you that diversification, but individual stocks are also incredibly expensive, right?
That's
Like,
true. That's
if you
true.
wanted to
Yeah.
buy one single share of Amazon, do you know what it costs right now?
Is it 1,000
It's like
something?
2,300 bucks just
It's
for one
23.
share. Yeah, one
Oh,
share.
what is Tesla now? Is it 800 right now?
Well, it was 800 probably before this call, but they just had earnings actually today.
They beat it.
And so
I saw.
they had a surprise profit, and it was trading around, I think, 860 or 870 after hours. So
Wow.
yeah, our CEO is actually going to be on CNBC chatting about this today, if not tomorrow. So be sure to check that out. He's, we were kind of the lone bulls on Tesla for a long time when it was in
I've
the
seen
gutter.
that.
So he has
I've seen you
been
guys
following.
talk about it. Yeah.
Yeah,
For
we've
like
been
2 years
following the
now, I've
company
seen it.
religiously.
Yeah. Well, it's doing great. Wow. Yeah, you're right though. It's very expensive, the individual stock versus like going into an ETF where it's more diversified and maybe less risky. So that's pretty good to know. So maybe if you're just getting started, probably since it's less expensive, consider ETFs and mutual funds then, I
Yeah.
imagine.
And another thing, maybe a lot of your viewers are interested in too, just because they're in that real estate world or at least interested in it, is something called REITs. Have you ever heard of a REIT?
Yeah, real estate investment trust.
Yeah, so REITs are actually publicly traded real estate investments, or you can kind of think of it almost like a ETF or mutual fund of just real estate. And
Mm,
so you can, I hear a lot of people saying that they want to buy rental properties a lot too. And there's other ways to generate income while you're possibly looking for a rental property or something like that. And these are called REITs. And you can buy
got
REITs in
it.
different industry, like retail or Vegas, whatever it is. And so you can invest in these REITs and essentially just collect the rent payments as a dividend
Hmm.
payment to you as a shareholder. So they're also pretty unique vehicles as well.
Yeah, I actually owned a Peak, PEAK. The only problem was most of its holdings is in the seniors community, and because of the pandemic, it unfortunately went down because that was the bracket of people that were most in that risk environment. So I did lose money on that. So, but like you were
Yeah.
saying, there's other REITs that I also have, and I'm sure other people have, that it does pay you that dividend. So instead of having to save so much money and throw all your money or most of your money in a duplex or fourplex or an apartment and play as a actual, a manager to receive all the money from tenants, you can just let a company do it for you. I
Yeah.
do like that.
And not only the headache too, right? Of dealing with tenants and all that
Yeah,
as well. It's a lot easier just for it to get credited to your brokerage account. At least that's how I like to do things.
that's right. What do you recommend in terms of, like, let's just say, since we're talking about REITs, what do you normally look for? Like, what type of ratios do you look out for? Like, there's the PE ratio, uh, earnings per share. Well, what do you kind of recommend to kind of gauge to get an idea if it's maybe a little too risky or things like that?
Yeah, great question. I've actually been chatting about this a lot over the past couple of weeks with a few clients and friends as well. And there's a misconception that the stock price, when you look at a stock, right, like Amazon, for example, $2,300. Well, it must be expensive, right, if it's that high. And a lot of people don't realize that the stock price actually has nothing to do with the value of a company. A
Hmm.
stock that's trading at 2,300 a share can be worth significantly less than a stock that's trading at $50 per share. And the reason that that is because we value companies off of a market cap, right? And so market cap, and this is getting a little bit technical, is the share price, so the $50 per share, times the amount of shares that are out there, right? So if there's 100,000 shares, whatever it is, you have X
Okay.
market cap. Now, you can value these companies using different metrics, and there's really two main schools of thought. And the first is actually kind of similar to real estate. So you mentioned multiples, and there's many different ways to value companies via multiples, right? There's price to earnings, which is you take the price divided by the earnings per share. You can do price to sales. You can do price to book, cash value per share. All of these different metrics, right? And you're like,
There's a
okay, well,
lot.
which ones actually
Hmm.
matter?
Yeah.
And all those are is kind of think of it like in real estate, right? When you're on a block, how do you value the home?
The comparables generally.
Right? So
Yeah,
you take that
population growth.
comparable.
Uh-huh.
Exactly. So if there's a house that's worth $1 million, right? All the houses on the block are worth $1 million, and one sells for 800,000 because that person needs cash. All the other homes in the surrounding area probably go down slightly, at least temporary, right?
Correct. Yep.
So it's the same kind of concept in markets where different sectors and different basically companies have different multiples and different ways to value them. So what you want to do is you want to look at the block, let's say, of tech companies. And tech
Oh,
companies generally are valued, let's say, off of a price to sales multiple. And there may be, let's say, anywhere from 25 to 30 is a normal price to sales. Versus like the S&P 500, you want to generally value off of price to earnings. And it generally has around a 18 or 19 price to earnings. So what you do is you end up breaking it down by sector, and different sectors have better multiples that give you an idea of if they're cheap or more expensive at that valuation or price. So I
so you
know it's
compare
getting,
apples to
kind of in
apples,
the weeds. Exactly,
right?
apples to
Yeah.
apples.
So if you're looking
Um,
at a PE ratio in the tech sector, it may be higher than something in the consumer staple sector, right? As far as the PE
exactly.
ratio. So you gotta, if you're looking at Tesla, you want to look at something else that's very similar to it and compare the PEs and things like that. Okay, that's good to know.
Exactly.
What about now though? Because the stock market has been very volatile. I know it's on the up right now, but would you be looking more at value stocks or growth stocks? I'm kind of trying to, see what a lot of people are probably wondering right now that are investing. Maybe they're saying, I'm going to be on the fence and not invest and stick with cash, or should I buy value or growth stocks or gold? I don't know.
Yeah, good question. So this is an ongoing debate in the finance world. So we're growth investors really here at Gerber Kawasaki. You know, that is our specialty. Is we're usually kind of overweight technology. We're a young firm. We like growth. A lot of our clients are looking for growth. So that's what we kind of specialize in. And growth has really outperformed value as a kind of industry or sector, you could say, over the past like 20 years. And typically they kind of do this where they'll intersect with each other and kind of revert to the mean. But we just haven't seen that with the value companies. And it's an interesting paradox. I'm actually wearing one of my friends who runs an ETF, value
Big?
ETF.
Uh,
Yeah, so he
cool.
actually wrote a good book called The Acquirer's Multiple. Tobias Carlisle, he's actually on Twitter too. So go give him a follow and read his book because it goes into kind of the weeds of like why is value investing. You know, the point is zigging when it's supposed to zag, and all of these different
Yeah.
concepts. Because it just hasn't performed over the past couple decades, and there's a lot of reasons going into it. Um, One of the reasons a lot of times value companies don't do well is because there's what's called value traps. Have you ever heard of those?
No, what's that?
So value traps is the concept of, you know, a company that looks cheap and they're like, oh my gosh, like why is this so cheap right now? But it's cheap for a reason, right? And that reason
Mm,
is generally because they have like falling revenues, or maybe they're in you know, the legacy car makers who know that their death is eventually going to happen because of electric vehicles. Or it's the oil industry because they generally know that renewable energies is going to kill them off anyway. So these sectors, they look cheap, right? And they look like they could be a value, but is it really a value if it ultimately is going to zero? What's
yeah.
cheap can definitely get cheaper.
Yeah. Okay. As we saw with oil recently, right?
Yeah, totally. The
It
complete
went
collapse of
negative.
it.
Yeah. Okay, that's good to know. Now, in terms of like determining the volatility of a specific stock, I know all this is very difficult to do, and it all is based on the person doing it. But do you ever look at the beta, the systemic risk? I know if it's higher than one, the more volatile it is. If it's less than one, it can be less volatile. Do you ever look at that? Is that something to look out for, or not really?
That's what we kind of do as like portfolio managers. Like as an individual investor, like do you really need to like understand the details of beta and kind of systematic risk and unsystematic risk? Like you'll probably end up confusing yourself more than like, you know, actually getting any value out of it. But yeah,
Mm,
beta is just what you said, right? It's how much the stock moves up and down. So, you know, generally in a portfolio that's more conservative, you want a lower beta, right? And you can find ETFs or funds that have lower betas that achieve that. And generally, you want the lowest beta with the highest return. And that's kind of what gives you this kind of risk adjusted returns, or you'll hear a lot of people talk about Sharpe ratios too, which is another metric on kind of how to view those things. But yeah, generally, I wouldn't say beta is something that we jumps out at us and we're like, oh, we need to check the beta of this stock.
got it. Okay. See, that's what I think is very important, and people need to understand that is sometimes people just say I can easily buy stocks on my own in ETFs, and I know how to gauge by looking at, they maybe they Google it and they figure they can do it by themselves, but in reality, it really comes down to an expert to kind of help them with that, someone like you, to really guide them and then revert back to their plan so they can say, hey, you're spending all this money in this specific sector, but you're trying to buy a house in 2 years. Maybe you should diversify a little bit more. That's kind of
Yeah,
what I'm getting out of this call, right?
it's kind of the same thing. Like, do you think that you could fill your own cavities or clean your own teeth, right? Like, no, you
Yeah.
probably want to go to a dentist because they're going to do it right, right? Or like, you can't just read an entire book on brain surgery over a weekend and then think that you're going to be a brain surgeon the next week, right? So like, the finance world and like the real estate world, like these are people that study these things their entire lives and they have massive amounts of resources behind them, right?
Hmm.
And so it's very hard to compete with professionals like that, and from an investing standpoint. But it's also, we have to remember that while this all seems great in theory, while we, you know, read about it and we think, oh, I can, you know, save $500 a month and put it in the S&P 500. Well,
Yeah.
it's the emotional aspect of like, well, what happens when when your $100,000 turns into 40 in, a couple months, because you were too aggressive. And so a lot of this battle is really that emotional intelligence and making sure that you have someone to keep you accountable. Because while it might work great over the first few months or even year, it's down the line where you need to remember, when in 2 years, when you forgot about that book and you're like, why am I doing this again? You have someone to remind you and teach you about it. And this brings up a really good point. Something that we haven't touched on yet is called dollar cost averaging, and it's one of the best ways for young people to invest. Have you ever heard of that?
I have, but I'd rather have you explain it. I know you put a little bit of investment amount of dollars one day and then wait another day, and you kind of average it out on price or something like that.
Yeah, so it's a method of taking a fixed amount of money and investing it on fixed time periods. So it's a fancy way of saying, pick a day of the month and pick a dollar amount that you're comfortable with and invest it every single month, no matter what. If the market's up, if the market's down, just invest it, right? And
Yeah.
what's naturally going to happen is, let's say, $500, for example, naturally as prices get more expensive, you're going to buy less shares with that same dollar amount, right? And as prices get cheaper, like they are right now, your $500 is going to go a lot further. And what ends up happening is that you end up averaging to a lower cost over time. And so I see this mistake a lot. They're like, oh, well, when is the right time to invest in the market? I think it's too expensive right now. I think it's too cheap right now. Like, Donald Trump is ruining the world. We don't know what's going to happen. Brexit this, we have the coronavirus. They're like, when is the right time to invest? There's so much going on. Well, the answer is this month, right now. Just start, right? You just want to take a dollar amount, say you want to invest 10 grand. Don't invest all 10 grand at once. Spread it out over the next 6 months and invest a couple grand here, a couple grand next month, a couple grand the month after that. And you will probably be better off than if you just pick 1 or 2 points and just threw all the money at it.
And that makes a lot of sense too, because a lot of people think they can time the market, and in reality, I don't think most people can. And then thinking back to recently in the fourth quarter of 2018, I think we hit the bear market for the stock market at around December, right? And then some people decided to go just towards cash, but they missed out on the stock market soaring. So you just never know, right?
And the same thing, right? If you would have panicked in March, right? We were down 30%. If you would have jumped out, well, we bounced significantly. Like, the market's only down like 9 or 10% on the year, which is amazing. Well, it's insane how much it's come back this quickly. And it's because the stock market, right, isn't the economy. And the stock market's trading on the future, not what's happening currently. And so what this is kind of telling us is that people are, pretty optimistic that we are going to somewhat open up the economy in the near future here, and that life will relatively get back to normal. Maybe we're not going to concerts, but maybe we can still have some sort of normalcy back.
And then that's something you're constantly looking at every day on the different sectors of who's likely to get more impacted with this pandemic versus another sector. So if you had to say which sector is probably going to get hit or already got hit most versus another one that probably hasn't. I think you already mentioned entertainment, right?
Yeah.
As far as the outdoors events and things like that.
Totally. We're truly seeing, the divergence of like the retail economy and the digital economy, right? And we've had them intersected for a while now, but now we're seeing, the Facebooks, the Zooms, the Amazons, the Googles, the Apples of the world, things, Microsoft, companies that have moved to cloud, right? And they can deliver their products and they don't need to see a customer, are doing extremely well, right? A lot of these companies have honestly recovered most of the downturn that they've already experienced, versus like the retail sector, right? Companies that were already kind of dying on their way out, that were clinging to every last thing that they could just to stay in business, like the Macy's, the J.C. Penney's of the world, the Sears, right? Like these companies that were already done. Malls, like, people like, these are already things that were on their way out, and I really think that this was more of just like the kiss of death that's sending them off into the distance. And what we're going to see moving forward is this more digitally integrated system. where, you know, people realize, oh, well, I don't have to go to the office. I can get my job done from home, and I don't have to waste gas and cause traffic and do all of these things. So, you know, technology and healthcare are obviously sectors that we think would do well in this environment, while like real estate and energy and or sorry, not real estate, retail, energy, and those types of things are hurt significantly.
Well, some real estate is getting hurt now too because of the forbearance issues. Um,
Yeah, and like
but
for example, these retail REITs that we were talking about, a lot of them
the
got
malls, right,
destroyed.
connected to malls.
Yep, because guess what? No
Yeah,
one's going to the malls. They might not come back for a long time.
yeah. Same thing with office buildings, right?
Yep, exactly.
Now, do you probably expect that more people may work from home maybe nowadays, moving forward? Our culture may change, and kind of like you were saying, a lot of these companies are adapting from being brick and mortar versus being doing that, but also sending out things through e-commerce and things like that, getting delivered to your door.
Certainly, I feel like we have to, right? At this point, you know, nothing like pushing innovation like a pandemic. It'll definitely. I think that we've changed a little bit behaviorally. You know, definitely, it's not going to be okay to go to work if you have a cold anymore.
Yeah,
You
yeah,
know, it's you know, generally it was, oh, we'll suck it up type thing, but you know, you can't do that anymore. There's just too much embedded risk, and so yeah, I think we will see a lot of more telecommuting. We'll see people that well, smaller offices because maybe the whole team doesn't need to be there. I definitely think that we'll see those changes.
okay. Now, tying back to your clients that are trying to save up for a down payment on a home, since that's very crucial, they can put as little as 3% down up to 20% or more. Do you kind of keep them on track with their expenses, like maybe in a spreadsheet or something? And then on top of that, do you also focus on maybe their FICO score and things like that?
Yeah, so generally we recommend our clients have about 20% down for their down payments. We like that as kind of the threshold. People, a lot of the times expect that real estate never goes down, right? And we've seen
Yeah,
that it does in certain times. And so a lot of, some people put down 3, 5%, and then they're not planning to stay in that house, very long, maybe 3 years. And in that 3 year period, the house value can go down 5 or 10%. It's not uncommon. And you can get underwater in your investment and lose your entire investment very, very quickly. So generally we want to
totally.
hit that 20% down payment is what we recommend for people. As far as what we help them with planning, it's from A to Z. So, and they can be as involved as they want to be. So it's from, setting the goal of we want a house, creating the actual plan of we need to save and invest X amount of dollars and invest it this way to get there in this time period. And then once that time comes, we're completely independent. So we can refer out to individuals that we like, real estate agents like yourself who can help them find a home. We have networks of loan officers that can help us decide, okay, what type of loan should Johnny or Sally get based on how much they have, what their cash flow is. Should it be a fixed or variable loan, 5 or 7 year arm, whatever it is, depending on their specific type of situation. And we guide them through that entire process. And that's about as extensive as it gets, but we'll also sit down and figure out, okay, based on everything that we just talked about, what is that mortgage payment going to be? Can you afford it? What are the property taxes going to be every single year, and
Mhm.
so on and so forth.
And that's why I think your role as an investment advisor is so crucial, because a lot of people need to be brought back down to reality, and you provide them that objective standpoint. Because a lot of people think that, like you were saying, especially a lot of realtors in my industry are always saying house prices will always keep going up. This pandemic isn't going to bring down prices. If anything, it might go up, things like that. But it's very important that someone works with someone that's very objective with them, because I always tell my clients, especially that bought in the past year or two, especially now, if you're going to buy, make sure you hold it for at least 5 to 7 years, if not maybe a little more, because it's all a cycle. Eventually, it's going to come down. And I like the idea about the 20% down. That's kind of ideal for, like you were saying, for your clients. That's what you recommend, because if you put anything less than 20% down, you're paying the private mortgage insurance, which can get very
Yep.
costly.
Totally, that's a great point. PMI is a huge added cost. And and that comes back to our point again, where we don't want to put every single last dollar that we have into a house. It may seem great, but you're gonna forget about a lot of the other goals that you have. And what's also kind of interesting is these interest rates at this point too, right? Like, have you ever had people that they just want to pay off their entire house?
No, not yet. My clients have either already paid it off, like they're in their 60s, 70s, or they're still like in their 40s and they still got another 10, 20
Yeah,
years. I haven't
it's
been through that
interesting.
situation.
It's interesting because interest rates since like the 1980s essentially have been consistently on a downward slope, right? As the Fed just continues to cut interest rates, and so um, we were always taught by like our parents and our age that like pay off your mortgage as fast as possible, right? Pay it off, pay it off, pay it off, pay it off. And that's generally because the mortgages that our parents got were 8, 10,
18.
15%, yeah, even
Yeah.
more, right? And so
Yeah.
a lot of the times it made sense to pay off that mortgage as fast as possible. Well, now the stock market averages around, let's say, anywhere from 9 to 11% per year annualized over the long term. Okay. And so if interest rates on a mortgage, you're only paying out at 3 or 4%, but you can invest in the market, even a balanced portfolio, let's say, and for example, just earn 8% over the long term. Obviously, we have to run the numbers for your exact situation, but a lot of the times it doesn't make sense to pay more on your mortgage. And it makes sense to take that extra money and go out and invest it and earn a rate of return over what you would be paying out on that interest rate. And so that's kind of a more advanced concept too.
Is
But
that like where you need to kind of gauge the situation and understand that leveraging yourself can be good if it's done in a healthy manner versus saying, you know what, I don't like debt. I'm just going to go all cash, but then all your money's tied up to that one asset, and that now you can invest in
exactly.
your retirement, individual stocks, whatever it may be.
Yeah, exactly. Especially you see this a lot with like older clients too, right? They're like their entire net worth is just locked up in their house, and that's the only
Yeah,
asset that they've ever saved for or invested for. And so there's a lot of the times that just doesn't make sense anymore.
that's a good point. Thank you for bringing that up. Yeah, I mean, these interest rates are very low right now, so people should definitely take advantage if it makes sense for them. And to be honest, personally, I believe home prices are going to come down a bit. I don't know if you've been seeing on social media a lot of people saying they're going to go up or they're going to stay stable, but I am kind of thinking the opposite. But I guess
I,
time will play out.
yeah, I think we're in the same boat there. I think we'll come down, but it's hard to tell, especially here in Southern California. It's such a unique market compared to the rest of the world,
Yeah,
where there's only so much supply.
that's right. Yep. I don't know if you saw the last video I did. We were talking about accessory dwelling units where you can essentially create a smaller unit within your primary residence in your lot. I mean, inside the primary residence or within your lot. So instead of
Gotcha,
buying a duplex, you could always build something out and get that cash flow.
gotcha. And like
Um,
Airbnb it out, or
we can do that too if the city allows it. Yeah. So there's always ways of investing. So that's why I'm glad I had you on today. I think people need to really consider what they're doing and maybe not throw all their money in the robo advisor and actually talk to a human being, especially when people are always saying, I don't have enough money for a down payment on a house. Well, maybe if you planned ahead and worked with someone like yourself, you could have probably got to that point.
yeah. And if any of you guys are out there and listening and have questions, please do reach out. My email is brett@gerberkawasaki.com. Or follow us on Twitter. I'm at Sifling Trades. We put out a ton of content on there. I'm sure Andrew will link it for you.
Yep.
But reach out. If you have any questions, if you're just ready to get started, we have an awesome team of advisors. Like I mentioned in the beginning, we have no investment minimums, which is super unique. You can get your own personal financial advisor and have a no minimum investment. It's pretty amazing,
That's
and have that
incredible.
personalized and human touch, right? So please do reach out if you guys have any questions at all.
All right. Thank you so much, Brett. I'll make sure to include that. And I appreciate your time. Thank you so much.
Yep. Thanks for having me on, Andrew. We'll talk soon.
See you.
See ya.